Welcome to Stony Finance Lab channel.
How to start investing for retirement using a 401k, a strategy for long-term returns and reducing risk to retire comfortably with peace of mind by maximizing savings while maintaining lower levels of risk. By Zachary, Slutsky, EthanTaveras, CJ Trenkle, Austin Ward, and Jessica Witt.
We believe this portfolio analysis would suit best for the younger generation, individuals who are recent college graduates and young professionals who are entering the workforce and looking to invest their money they're making and letting it grow over time. The age range in general we think this portfolio would suit best is 22 to 25-year-olds. This target group of investors share common goals, which is to start investing their money now and letting it grow for their retirement. As of 2021, the average 401k balance for this target investor age range is a little over $5,000, compared to their net worths of almost $30,000. We believe that this analysis can help increase those numbers and show the younger investors that if they start investing now, it can benefit them in the long run.
As a young professional, you will hopefully be setting a variety of different investment goals for yourself. These goals include short-term, mid-term, and long-term goals. In this presentation, we'll focus on long-term investment goals which require a minimum investment period of 10 years. There's a variety of different long-term goals you can set for yourself, but for now we'll focus on helping you invest your savings to maximize growth but also retain lower levels of risk. This requires strategic research and planning, and there are a variety of different accounts you may consider opening up. To help you achieve this goal, we'll recommend for you to start off with a tax-advantaged retirement account, and more specifically a 401k account. You can open up one with your employer, and the 401k account is a tax-advantaged account because any contributions you make to the account through the year can be deducted from your overall income when filing your taxes.
The asset classes that will be used in this portfolio are a mixture of stocks and bonds. In these classes, the financial instruments that fall under the stock category are index funds and ETFs. The three most popular funds that investors hold in their 401ks are Vanguard Total Stock Market Index Fund, the Fidelity Contra Fund, and the JP Morgan Large Cap Growth Fund. Listed in the slide are the symbols and tickers that these funds are traded under. There are also a variety of both government and corporate bonds that can be molded into your 401k plan. But before you decide what you want to invest in, you have to decide where you want to invest. TD Ameritrade, Fidelity, and Charles Schwab are all investment firms that allow you to open 401k accounts with them. Each one offers different benefits, so make sure you do your due diligence and research which firms fits your needs best.
To start investing for retirement, you begin by opening a 401k with your employer. You will then be able to choose what to invest in to start growing your retirement funds. Index funds will incorporate a variety of stocks and bonds into the plan, allowing for diversification and lower risk. Diversification will help shield from loss since your money will be distributed among different assets. ETFs are also a good choice to invest in due to the low cost and diverse group of assets that they make up. The next step is to invest a specific percentage of your salary to your 401k every month. It's important to invest at least as much as your employer's match in order to use the full benefit of the 401k. As time goes on and your salary increases, you should also increase the percentage you are investing in your 401k. The next part of the investment strategy is to return to your 401k at least once or twice a year. You may need to rebalance your investments. If you were too risky at the start, you could decide to invest more in less risky assets later on. Also, it's important to watch for continuous large losses. Check out any assets that are underperforming major market benchmark indexes like the S&P 500 so that you could change these investments if needed. When you finally reach retirement or age 59 and a half, you could withdraw funds from the 401k. Opening a 401k is a good strategy to begin investing because you're not taxed until retirement. Also, because your employers can match your contribution, your retirement funds in your 401k will grow faster. You could start this investment strategy at a young age and be ready to retire with funds raised over time from your 401k. For our investment strategy, we will use ETFs that track the performance of the S&P 500, S&P 600 Small Cap, and the ICE Bank of America AAA Corporate Index Total Return.
When comparing each asset, we need to account for both risk and return. Risk is measured by the standard deviation, referred to as volatility, which is the dispersion of returns. we expect 95% of the returns to be within 2 standard deviations from the mean. Thus, a smaller standard deviation is better because we don't expect larger downside losses. The table presented summarizes monthly return statistics of each asset from February 1989 to December 2020 for a total of 383 months of returns. This data will be used to analyze the returns of the portfolio throughout the remainder of the presentation. Note that the bonds have the highest Sharpe ratio, meaning they have the highest average return in excess of the risk-free borrowing rate per unit of risk. To build our portfolio, we needed to decide what proportion of the portfolio to allocate to each asset. A portfolio invested in 60% small cap stocks, 20% in the S&P 500, and 20% in bonds will have strong long-term growth because of the overweight allocation in riskier assets. Additionally, as we are approaching the end of the investment horizon, we can change the weight allocated to each asset to reduce risk. We propose a portfolio where 10 years prior to retirement, we change the allocation to 30% small caps, 30% in the S&P 500, and 40% bonds, and 5 years prior to the end of the investment horizon, or retirement, allocating 20% to small caps, 30% S&P 500, and 50% bonds. The chart to the right presents the growth of each investment strategy over the 31 years while depositing $1,000 and properly balancing the portfolio at the start of each month. Reducing the riskiness of the portfolio prior to retirement is important because we want to depend on the money in the account, unlike the static portfolio that is potentially subject to larger drawdowns like the one seen in March 2020 when the account value actually dropped below that of the time-varying portfolio. When comparing the two strategies, the static portfolio has a larger portfolio value at the end of the investment horizon, slightly higher monthly average return, and the best monthly performance, but the static portfolio also has a worse standard deviation, Sharpe ratio, and lower worst month. For reference, classic financial literature suggests a portfolio of 60% stocks and 40% bonds. Using 60% S&P 500 and 40% ICE B of A index, the monthly mean would have been a much lower 0.671% with a lower volatility of 2.5%, but only would accumulate about $1.4 million. Lastly, we want to compare each portfolio performance over the last 10 years of the investment because we are looking to reduce risk during that time. As you can see, during the last 10 years of the two investments, the static investment had a much lower loss in the worst month than that of the time varying. Additionally, the static portfolio had a much larger loss during the worst 12-month period and experienced larger volatility, while both portfolios had similar returns during their best 12-month period. Now, during the last 5 years of the investment, when the portfolio allocation in the time-varying portfolio is again adjusted, we see similar results, but the difference in volatility between the two portfolios is larger, which is ideal because as we approach the end of the investment horizon, we want the risk to be lower so we can be more certain of our portfolio value for retirement. Using a 401k, most employers will match 50% of your contribution to your account, up to 4.3% of your annual salary. That means an individual with an annual income of $75,000 can get the maximum employer match by saving 8.75% of his annual income. Saving $547 per month will be matched by about $269 by the employer for a total 401k monthly deposit of $815.63. Based on the average monthly return of the time-varying portfolio strategy with portfolio rebalancing at the beginning of each month, an individual who begins saving at 25 and retires at 65 will grow his savings over 40 years to about $4.18 million. An investor who follows the same strategy but begins saving at 35 years old would need to save about $23,400 a year to reach the same amount by 65. The key is to invest early and let time work for you.
Mistakes to avoid when investing for retirement. Here we will be covering a few common mistakes that can be easily avoided so long as you're educated and aware of them. Mistake number 1. Not maximizing your 401k contributions. Maximizing your employer's 401k plan match is one of the most important strategies when planning for retirement. It's money granted to you from your employer after you make pre-tax contributions to your retirement plan from your paycheck. If you fail to contribute to your 401k plan, you give up the opportunity to receive the employer's matching amount. In addition to reducing your taxable income based on your higher contribution, you'll be more prepared when you retire. Most people tend to underestimate the amount of money they will need in retirement. It could be more than 30 years without working. Mistake number 2. Not properly managing costs. You want to avoid making early withdrawals from your retirement by all means. Penalties are extremely high, and the funds are taxable. Although rarely occurring, very large purchases do happen, and it is important to plan ahead for them. An effective way to avoid an early withdrawal is by building an emergency fund. This will provide you with more cushion and will safeguard your retirement funds in the case where unexpected substantial funds are required, like if your car breaks down or emergency surgery is needed. Also, your everyday lifestyle is important when it comes to saving money in general. You must always ensure that your income is greater than your expenses. Mistake number 3, panic trading. Long-term investors should never sell stocks out of fear or panic. According to data going back to 1930, Bank of America found that if an investor missed the S&P 500's 10 best days in each decade, total returns would be just 91%, strikingly below the 14,962% return for investors who held steady throughout the ups and downs. To conclude, as someone just entering the workforce, it's important to start thinking ahead. It may appear that you'll have many years before preparing for retirement, but the sooner you start, the more you will gain. Take advantage of compounding now rather than later. Maximize your 401k plan portfolio with strategic investments, and remember to monitor your performance and risks. Your future self will be grateful as you retire one day with freedom and peace of mind.
Thank you for watching this video. Please feel free to like, comment, and subscribe to this YouTube channel.